There you go.
Sorry, I always forget that part.
So through the week, we've got 4 different calls currently. Sundays, 8:30 p.m. The activation Zoom, Mondays at 2 p.m. Eastern. All these times are Eastern time. Peter and Eddie are making live broker calls and coaching people on what to say and how to talk to brokers. Tuesday evenings at 8, we've got an underwriting Zoom with Eddie and Ed. And then tonight is our Wednesday Zoom. We do every other week. And we do a topic that's finance related. So as my wife there said before, we're Jerry and Shelly Miles. We are the founders of Adventure Commercial Capital, and we're commercial mortgage brokers. We lend on commercial and investment real estate nationwide. We can lend in all 50 states and even the Caribbean. So, just a little bit about us and how we got to where we're at. We've run a commercial roofing business for the last 20 years. About 10 years ago, we got started investing in real estate, buying cheap little houses, and real soon learned that we needed to start getting funding and things to be able to expand our business and grow. And through that process, we really ran into some roadblocks and hurdles. Ran into some guys that just weren't real honest and kind of shady characters, which real soon we learned that there was better ways to do things as far as finding funding, and that pushed us into this business. Through that process, we joined the National Association of Commercial Loan Brokers. Went through a bunch of training with them, and opened our company, Adventure Commercial Capital, to kind of fill the gap there for real estate investors. So that's what we've been doing here for the last 3 years. We still have a construction business running, and we're still investing in real estate here in Northern Kentucky where we live. But it's our passion here to help real estate investors to be able to grow their worth and to grow their portfolios and to serve you guys in that fashion. So y'all can go ahead.
Hey, can you guys help me out with something? Because I think I dropped a ball on sorry, there's more people coming in. I dropped the ball on sending out the email. I think I sent a wrong date. Can you guys do me a favor? And Jerry, go ahead and put it back on the Freedom Chasers community ecosystem. If you guys can take your phone out and take a picture of this and post it and tell everybody that we are live right now, because I think I really did drop the ball on the email that I sent out. It said January 25th. That will help us out so much for everybody getting in here and letting them know that we're live. Post it anywhere, and I'll post the link in here so you guys can have it if you need to share it with somebody. Thank you, guys. All right, go ahead, Jerry.
All right. So right here on the screen is our contact info. That number is my personal cell phone number. That comes straight to me, and both of our emails are there. Want you to feel free to go ahead and reach out to us with any questions you might have with finance. You know, in the debt market, just anything and everything, feel free to call. We've seen a lot of deals and done a lot of deals. So, you know, if it's something we can't help you with as far as doing the business for you, you know, usually we can point you in the right direction to help you in other ways. So, you know, take a screenshot, you know, take a picture with your phone, whatever you want to do there. So, next up, I want to ask you all to tell us a little bit about yourself. Yeah, the numbers are down. We've been having 50 to 60 people a week on here, and they're at not even 30 right now. So I guess you probably did drop the ball there. So, but if you'd like, go ahead and raise your hand and tell us who you are, what you do. And we go at time for 2 or 3 people to jump up and do that if you'd like.
Anybody?
So go ahead, JJ.
Hello, my name is JJ Miles, and these are my parents. And I've been doing YouTube for the past few months, and I'm just about to hit, or I did hit 500 subscribers yesterday, and I dropped a little bit, but we're trying to do really good with that, and hopefully I'll hit 1,000 subs here soon. So yeah, I'm gonna put my YouTube channel in the chat for anybody that wants to go and check it out.
Awesome. And you know, raise your virtual hand if you want to talk, and we'll unmute you and let you introduce yourself. If you don't want to do that, you know, I'd like to, you know, encourage everybody to put your information in the chat. You never know who's in. I know I recognize a lot of names in here, but I've recognized a few people that are here in the group that are, you know, some bigger hitters. So you might want them to know you. Put your information in there. You never know who's going to see you and decide they want to give you a ring or reach out with a message or something. And you know, we're all just one relationship away from doing big stuff here. So. All right, so we'll go ahead and move into our, you know.
Okay, I'll introduce myself.
Hey, hello? Grant. Yeah, go ahead.
I'm Gail Grant.
Gail, sorry.
That's okay. I'm a little shy. I jumped in there, but yeah, I do. I have a few rental properties, and I do mortgages in the daytime. Any state, give me a call. Just residential. That's all I do. I just handle the residential up to 4 family, and then Jerry handles the big stuff and some of my stuff. Anyway, that's what I do. Just want to introduce myself.
Yeah, encourage everybody, if you have anything residentially that you need help with. Gail's a good guy. We go to church together, so you know, I can vouch and say that he'll take care of you and do a good job for you. So, and we got Philip. Go ahead and unmute yourself there, Philip, and tell us about yourself.
Hello, can you hear me?
Yeah.
All right, excellent. Yeah, Philip Jenkins. I'm a residential real estate agent in Virginia. I've got some rental properties in Virginia and South Carolina, but looking to move into multifamily. I'm interested in, for the most part, obviously, Virginia, South Carolina, Florida, and Texas.
Awesome. Okay, cool. Cool. Make sure to put your, I'm not reading the chat, but go ahead and make sure to put your information in the chat if you haven't already, Philip. It's good to meet you. Now we got Isabel.
Hi guys. I don't see myself, so I don't know if you guys see me.
I see a picture of a book cover there. Do what others refuse to do.
Oh my gosh. Yeah, I'm trying to mess with this, but It's not working, so I'm sorry.
Oh, that's all right.
I am an investor. I have been a long-term landlord, and I am on Alex Legend's mentorship.
Awesome.
And there's some people here that I think is there too. And so we are looking, I have a couple of properties as a limited partner, and now I'm looking to be a general partner and add value. I have done property management for 16 years in the DMV area, and I recently moved to Florida. So I quit a career of 16 years and moved to the palm trees and the sunshine. So, so I'm looking to do the same here and, manage my own properties with a group and of investors. So that's what I'm looking for. And I look forward to connecting with you all. I had a private message Shelly, but now I'm saying everything here. I had a prior commitment, but I really like this. It seems to be very valuable, and I hope to get the recording later, but I have to go to another commitment that I had. I just saw this, but seems to be very good, and I look forward to connecting with you all. I'll leave my information.
Awesome. Good to connect with you as well, Isabel.
Thank you.
Yeah, thanks, Isabel. I got your message, and the recording will be posted on the Freedom Chasers Zoom chat, financing Zoom chat.
Sounds good. I'll try to find that, how to find that, but I'll figure out.
I can tag your name on it so you can see it.
All right, thanks.
All right, thank you. Good to meet you.
Nice to meet you all. Bye.
All right, Aldo, I see your hand up.
Hey, what's going on, guys?
How are you?
Doing well. Long time no speak. I haven't been up
for
here
sure.
in a while. Yeah. So a little bit about myself. Actually my W-2 is in senior living, so I work as an asset manager for a senior living company out of Knoxville. Been doing before that operations, so essentially a property manager for the last 10 plus years, and now some asset management experience in the senior living side of real estate. I've been doing that for a while. My partner and I, Will Otis, we formed Stoic Holding Solutions, and we're trying to take down some multifamily units. We're trying to focus in the Birmingham market, and also a few markets in the Chattanooga area. So
awesome. Glad to see you.
Yeah, thanks for having this.
Yeah. All right. Well, we'll go ahead and get started here. We will.
Hey.
Yeah.
Thank you guys for your help. Yeah, people are starting to flow in now. It's
okay.
over 40, so
yeah,
that helps. It really did. Thank you guys.
All right. So we'll get started here with the current debt market. Current rates, the Fed rate here, as everybody, a lot of people on here probably know, we had another quarter of a point or 25 basis points hike here, this past week. And, so the new Fed rate is up around 4.75. SOFR here just past night was at 4.55. So sometimes when you're talking to a lender, they might tell you, oh, well, we're 2 points over the Fed rate, or 2.5 or 4 over SOFR, or depending on the lender, they're going to be different things. But they won't always tell you that. But there's some that'll tell you in that way. They'll say, well, we're going to be 4.25 over the Fed rate, if it's bridge debt or something like that. But just so 4 points over the Fed rate, that would get you at like 8.75%. So just, as an FYI, if, some of you all might not know that. So, But, rates are up. That's kind of what got us started here doing these Zooms and doing a current market update. The rates were changing every day, and the lenders, a lot of them are really scrambling, trying to either save their own butts and really pulling back, and then there's other ones that are in okay shape, and they're trying to take some of the market share. And it's even that way kind of in the broker community as well. We're brokers. We're not lending our own money. We've got a lot of contacts with different people and in different institutions that we lend out of. And so we see some of them that are doing both, and even in the broker space, because a lot of these brokers haven't, I've talked to multiple people that haven't closed a deal in 6 months. So they're getting hungry, and so a lot of them are pulling back, and they're not, they don't have the money and things anymore to do advertising, and a lot of them, some of them are hurting. For us, we're pushing out, doing these calls. We're adding advertising dollars, and we're trying to push ahead and take where some people are leaving off, and that's how we're handling it. And we're trying to deal with the lenders that are doing the same thing. So, rates are up. What's that mean? Things aren't affordable anymore. Your properties that you was able to buy, at a 4 and 5 cap or a 3 cap that, would cash flow. That's just not happening that way. And cap rates are changing. The mortgage rates are changing. And so, where a borrower might have had a 100,000 in his debt cost per year, 8 or 9 months ago, if his term ran out, and his rates have bumped up to double, he could be at a 220 or 225,000 a month or a year in debt coverage now that he's got to pay. So that's going to be hurting a lot of people. There's already people that are hurting, is a lot of these loans, the bridge loans that are coming due, and these longer term loans that are on 5, 7, 10-year terms, as those run out. That's if you've listened to some of the big guys out there talking, they're talking about there's going to be blood in the streets. That's what they're talking about, and it's all directly related to the mortgage rates. So, I think it was Grant Cardone saying the other day, he said, you want to be buying when there's blood in the streets, even if it's your own blood. So, if you've got properties that are maybe upside down right now, be trying to figure things out with that, but be looking at other deals, because there's other people that are hurting now, and you might be able to scoop up some deals. So, what are my lenders saying and doing? Like I said, I've had a couple of them that have got multiple products that they offer. They've pulled back on some of the products, and I've got others that are, here before this last rate hike, I had one that had dropped their rates by a full point. It's a private lender, and they were seeing that there's opportunities. There's other private lenders that are starting to feel some pain, and they said, hey, we're still in good shape, and we're well funded, and so they're lowering rates and aggressively going after deals. And so that's who I'm calling when I need deals funded. So that's kind of that in a nutshell. Just each one's different, and I'm trying to keep a handle on who to call for what deals, because it's changing on a daily basis depending on what's going on in their book of business, and where they're lacking and where they're needing to add to. So these here, I'm going to show 2 different sheets, and these are our agency loans. And I'll kind of I'm going to go ahead and skip these 2 and talk about Freddie and Fannie here to begin with. Freddie and Fannie have 2 different products. They have a small balance product, and then they have a conventional product. You know, Freddie and Fannie, you guys, I'm sure everybody's heard that name. You know, Fannie Mae and Freddie Mac are institutions that were put in place by Congress to help provide affordable housing. And so it's their job to kind of, you know, promote affordable housing, you know, whether it's through apartment finance or helping people to get good rates on a home or whatever it is. And in the last 6 months of 2022, they did not lend out all they were supposed to lend out. And you know, I don't know those amounts off the top of my head, but they were well behind what they're supposed to lend. And so they are aggressively coming into the new year, trying to fund more projects and to make up for that. You know, they're allotted certain monies, and they've got to use them, or there's people that are working in those institutions that are going to be without work more than likely. So, but Fannie and Freddie have come out recently, and they're going to go after deals that help them meet their 5 to 50 unit goals. So properties that are 5 to 50 units, they're going to go after those more aggressively than others. They were seeing that as just kind of a spot in the market that was kind of overlooked by banks and other institutions, and they're trying to help that space right now. So they each have a goal in 2023 to lend $2.5 billion and 18,000 units in this particular space. So if you have a 5 to 50 unit property, you know, that you own currently, you need to refi, or you're looking to purchase one, be a great time right now to look at, you know, the agency financing on these, you know, and the factors that really could impact pricing, get you better pricing, you know, is if you have very, you know, good sponsors that are very strong, you know, the loan size, the leverage. So if you're, you know, less leverage and a higher DSCR, you know, you're going to get better rates. But something that you'll hear with Freddie and Fannie, and our reps for Freddie and Fannie talk about this all the time, is, you know, when I ask them a question about this or a question about that, it's, Freddie and Fannie are really fluid. You know, so, you know, where you might lack in one area of their requirements, you'll pick up in another, and they'll still be able to do deals. So, something else that has come out for the month of February on Freddie, or actually, yeah, Freddie Mac small balance loans, which the small balance loans are 1 million to 7.5 million loan amounts. So this might be a $10 million property, but your loan amount will come in under that 7.5. They are cutting rates by 40 basis points for small multifamily loans that are put under application during the month of February as an added incentive. Freddie Mac is also adding an additional year of interest-only payments. The special pricing terms apply to all loans in all markets and at all credit parameters between 1 and 7.5 million. Rates are locked at application, and flexible prepayment options are also available. So now is the time to take the interest rate risk off the table for refinances and acquisitions. Not sure if your property fits? We can help. You know, we're experts with Freddie and Fannie lending. We can, you know, get the most competitive terms for your property with Freddie and Fannie. You know, so when you, I don't know, I've told this story quite a few Wednesdays when we've had these calls, but you know, when you call me to get a quote on something, you know, we quote things all the time and get quotes from Freddie and Fannie, and that I usually don't get a direct quote from Freddie and Fannie until we have a contract signed with a seller. We have a seller that signs a contract, and we'll get real hard on it, and we'll get, get hard numbers from Freddie and Fannie. But I've got 3 different sources for Freddie and Fannie loans. We had one recently that went under contract, and I had quoted, this is before all this stuff was going on, this was the end of last year, and I quoted the borrower. I said, I think we're going to be around 6% on this deal. And I quoted him, I gave him a quote sheet. Well, he got a signed contract. I went to the Freddie lender that I was liking at the time, and he came back and said, oh, we're at 7.25. And so I was, oh no, shoot. And so I said, this ain't going to work. I said, this is what I quoted the guy. I said, we got to make this work. And he said, well, I can't do nothing but this. And so I've got 2 other lenders that deal with Freddie and Fannie. I went to the other one, the next one on my list, and I talked to them, and didn't tell them what was going on. I just said, hey, I need, we're under contract on this deal and we're ready to go. Give us what you got. And they came back at 5.6. So one Freddie Fannie lender to the next. And, that one, the first one I talked to, it just, they weren't as hungry as the other. Sometimes each lender puts their own spreads and things in the deals. And, they weren't as hungry, and we're looking to make a little extra money. And so, on a $8 million deal like that one was, that lender was trying to make an extra $160,000 or so on that deal. So, just, we're always going to shop them around and try to find the best rates and terms for everybody. So, but y'all might want to take pictures of these. This here is the agency small balance programs. Freddie Mac, their small balance goes from 1.5 to 7. Actually 1. If we have a deal that the loan amount comes in $800,000, we can probably get Fannie to take that, or Freddie to take that one on. Like I said, they are self-proclaimed very fluid, so they can work and fit in where we need them to fit in. And then at the bottom, you see Fannie Mae small balance. They go from 2 to 6 million. As you see across the tops there, you see 80% loan to value at a 1.2, and then that's kind of your rates, and on down the line. So, but yeah, take a screenshot or a picture with your phone or something, and we'll move on
Are you able to answer a couple of questions?
Yeah.
So I have Philip, since you have your hand raised, would you like to ask your question?
Sure, I can ask it. Are you able to hear me?
Yeah.
So are there any restrictions on these 5 to 50? Are there certain property types or states or as long as we find something, for sale that's in that 5 to 50, then it's an eligible property?
Yeah, and it needs to have a occupancy of 90% or better. And I've learned here just this year, since they're behind on numbers, they're saying, my rep I talked to the other day was saying that they're even willing to kind of look at things that might be 85%. That we can get exceptions on those right now, because they're getting more desperate to lend on these. So and they have a lot of money that they're supposed to use. In our construction business, just as an example, I don't know if Freddie and Fannie will actually lose the money that they're given to lend out if they don't use it. But I do know, like in the construction business, we had done a lot of government work, and these government agencies, if they don't use certain funding that they're given, they will be given less money the next year for these projects. So they'll actually come to contractors like us and say, hey, we need your bid to be higher because we got to use these funds, and so as Freddie and Fannie is, kind of getting put in a vice with, hey, we're money out, you're here to promote the housing market, and housing's crashing, and you're not lending out the money we've got, they're going to get more and more desperate to lend. So, and that's kind of where we're at right now.
And Jerry, just one follow-up. Is there a good source of properties that are for sale, maybe under an existing Freddie or Fannie, the seller's trying to get out and you could potentially assume and refi? Or, is there any tips you could direct us to in terms of the best site to find these type of deals?
As far as finding those, I know that there's quite a few different paid sites where you can get info like that. And we were actually talking about, paying for Crexie's info, just so we can call on people that are coming due on their loan terms. But we've not done that yet. I know Crexie has a program like that. Who's the other one? CoStar.
CoStar.
Yeah, they have programs that you can buy into. They're out there. But I've not gone hunting for them real hard. So if anybody else knows of some, throw them in the chat and let everybody see them. So James.
Yeah, and what were you saying? Sorry, Aldo had a question. Aldo, would you like to read your question? Since you're not shy.
Yeah, sure. I was just wondering if there was a hard cutoff to the 50 unit thing, or if that's something that they were fluid about.
Well, yeah, I mean, they're still lending on all different unit numbers. They just came out and specifically said that we are pushing to do deals, 5 to 50 units. They'll lend on any unit numbers over 5. But specifically, they put that, information out publicly. So
does that mean that they're giving more favorable terms for those? For that? Okay. So if I have like a 52 unit deal that I'm looking at, are they going to be like, no suit for you in terms of favorable?
No. I mean, you see the rates and terms here. And when we're talking like, 5 to 50 units, where you see like the rate range where it might say 5.1 to 5.79, and they're looking, hey, we want to do these types of deals, and they're going to look at credit of the borrower, the property, the income of the, all the different variants. And then if it fits in that, you might save a 10th or a 5th of the point, I mean, it's just, they've come out and said, hey, we're aggressively going after them. So, you're going to get a little bit of more favorable rate in those areas. But, I wouldn't, if you find a deal at 52 units, I wouldn't say no to it just because of that. I would,
for sure.
Yeah. I just, just know that when they say, hey, this is what we want to do, that you're going to get a little better rate. So,
sure. Okay.
But I don't think it's make or break kind of deal, just now that 40 basis point in, I mean, that's almost a half a point here in the month of February. That's a big thing, especially when looking, and the Fed said that they're really not planning to pause the rate hikes come March when they have their next meeting. They're planning on doing another hike then. So, if you can get something locked in, it'd be real nice. So.
Yeah, that would be nice regardless to get something locked in.
Yeah, for sure.
Thanks.
Yeah, no problem.
Hey, you have time for one more question, James? Weekly.
Yep. Yeah, go ahead, James.
Hey, thanks, Jerry, for having me on here.
Yeah.
You kind of answered part of my question a bit on this pricing program that you have in the 40 points. Are we to take 40 points off of this, or is it already added in there?
Nope, take 40 points off of this. These numbers were put out. This specific one, I think, January 17th, you see here. And these numbers are still good today, even after the rate hike last week. They haven't changed since then. But yeah, where you see the Freddie Mac small balance at the top, you would take 40 basis points. So you're able to get all the way down in the 4s right now on the Freddie Mac small balance side. So.
Okay, sounds good. Hey, thanks.
Yeah, no problem. They're saying we could actually get to 4.84 is the lowest rate we can get to. So, I mean, there's not a bank out there right now that can get to that. So.
All right. Thanks a lot. Appreciate it.
Yeah, no
Great
problem.
questions. Go ahead.
And so now this here is the conventional loan programs. You see, as you get bigger amounts, so the rates get a little bit better. And they're the small balance to the conventional pricing right now is closer than I've ever seen it. Conventional a lot of times is 3/4 of a point to 1.5 points, higher than the conventional usually. But because they're trying to lend on these smaller deals, they're really making more favorable terms for them. So, all right, so we'll go ahead and get to our main topic. It's understanding DSCR. And I'll just tell everybody I haven't done anything with it just yet. But I get calls from real estate investors all the time, all day. My phone's ringing all day. I had somebody call me last night at what was it, 11:30 last night? Somebody was calling about a loan.
Yeah.
And the phone was ringing at 11:30, and I looked at it, and I'm laying in bed already. And Shelly looked over at me. She was like, "Don't even answer that." So, our phones go all the time, but
You
and I'm
gotta
not,
sleep
I'm not
sometime.
complaining. I like getting calls all the time. So, but a lot of calls I get, people, call me and talk, and then when I make a follow up about the deal that we're working on with them, they'll tell me, yeah, I found a DSCR loan, DSCR lender, and they're able to do the deal for me, and we're already under contract with this deal and this and that. And I'm like, well, all commercial mortgage people, that they're all DSCR lenders. Every commercial loan that you ever go to look for is going to be figured with on the basis of DSCR. So I just kind of wanted to do this because I've this whole idea of, oh, I'm getting a DSCR loan and like it's this big new thing. It's not a new thing. It's what's been around. It's gonna be around. And that's why I chose this topic to talk about, just to do a quick educational thing on it and what the banks are looking for and that kind of thing. But and actually, just so everybody knows as well, I commandeered the name on Facebook, and I'm starting a page on Facebook that's called DSCR Loans. And so anybody that searches DSCR Loans on Facebook will go to our page, and we're going to have some videos on there about our programs and stuff like that. But just trying to cover all of our bases. We want everybody coming to us. So, but DSCR stands for debt service coverage ratio. And it's a ratio or formula that banks use to measure cash flow's ability to pay the debt obligations. So whether it's an SBA loan, or any type of commercial loan is going to be figured on the debt service coverage ratio. So what do you have that can cover the debt? In comparison, for residential real estate, they use DTI, or debt to income ratio, and they figure your income in comparison to your outgoing money, and they figure, well, what can you afford to pay on a mortgage? And it's the same idea with commercial. They're looking at the income of the property or the business or whatever it is, and they're doing a ratio and doing some math to figure out if you're able to cover that loan. So, and so how do you find the DSCR? You can take the yearly NOI or your net operating income. So that is all the income on the property minus the regular expenses. And that gets your NOI. And then you divide that by your yearly debt service or the mortgage payment. So you can see the formula down below. DSCR equals net operating income divided by debt service. So you take your yearly NOI. So if you're net operating income or NOI is $15,000 a month or a year, whatever the case may be, and your outgoing debt service your debt service or your mortgage payments is 12,000, you divide those two and you'll get 1.25. And the 1.2 to 1.25 is the number that most lenders will not go under. If you're getting an SBA loan, on a piece of real estate or something, you can get it lower. Sometimes they'll go 1-to-1 if they think that the business has some growing to do. They'll go a 1-to-1 if you're covering it just barely. They'll do that, and there's some cases, with rental properties and things as well that I've seen lenders make exceptions on with the debt service. But if you're negative, generally there's no fixing that, and you're not going to be able to get funded. So that right there is in a nutshell, that is debt service. So we'll let's take this a step further here real quick, and let's just figure this on a real simple basis. Does everybody have a calculator that they can get out? Is JJ still on here, or did he go off working?
I'm not sure.
I see him. JJ. No,
JJ.
that's all right. He's probably doing something
Yeah.
else.
Oh,
You got your calculator?
Yeah.
All right, we're gonna do some math on a property. So we'll figure real quick just a single family house and how they would figure the debt service on a single family house. If you buy the house down the street and you want to turn it into a rental property, that seems to be what everybody calls and talks to me about. Hey, I want one of them debt service DSCR loans, they call them. The marketing behind it, I guess, is what's done it, but people think it's a new thing because, if you buy the house down the street and you pay, no matter whatever it is you pay, let's say you collect $1,200 a month or $1,200 a month. $1,200 a month times 12. That's going to get you $14,400 a year. Let's say that house has 2,014.4. Let's say that house has $2,000 a year in insurance or in taxes, and then $1,000 a year in insurance that you have to pay. So here's how I run a deal real quick. Now we have a little system we put all the numbers in, and it's real quick for us. But if you don't have our system to kind of type your numbers into and just punch out your DSCR and all those things, this is kind of how I run it. So you take that 14.4 minus the 3,000 for your insurance and your taxes. And so that leaves you with an NOI of 11.4. Okay, now on a bigger property, an apartment complex or something, you'd have a lot more expenses. But on a single family home, this is the way the lenders will look at it. And what I do is I go to Google and I'll type in on Google mortgage calculator. All right, and it'll pull it up, and it just pulls it up. Now you can't see it because of my background, but it'll pull it up and it'll have loan amount with your interest rates and all these types of things. So I'm going to say that we paid $125,000 for that house up the street. We put 30,000 down, so we're financing 95,000. Interest rate on something like this, we would probably be around 8% right now on a rental property. And so our monthly payment is going to be $700 a month. When you type it into the mortgage calculator, 8% interest, $95,000 loan. $697. So we'll say $700. So 700 times 12 is 8,400 a year. So 8,400 a year debt service. And our NOI is 11.4 divided by the 8,400. So that gets us to a 1.35 debt service coverage ratio. So you could borrow, 95,000 on that house. So hopefully that helps just a little bit, kind of just running the numbers real quick. If you're running for an apartment building, I mean, they do the napkin underwriting and things like that, but you can go to that mortgage calculator, type in any amounts, any interest rate, and you just type it in, do a Google search, mortgage calculator. It'll pop up the mortgage calculator, and it's a real quick way to find out your monthly debt payments. So hope that helps. So, we see debt service. I mean, that's our job is dealing with these numbers every day, all day. So, hopefully I'm explaining it well, and you guys are understanding. If anybody has any questions on that, we'll take time here in just a minute for some question and answer, or just anything you might have questions on. But when you come to us and you're looking for a quote, this is multifamily we're here talking about generally. These are the things we would need when we're looking at different property types, whether it's, we fund hotels, storage, we fund all kinds of different projects, single family rentals, 1 to 4s, all those things. We have different things we need for each one. But when we're looking at multifamily, T12, rent roll, and OM or offering memorandum is helpful. We don't have to have it. But it's helpful. It helps us because, it has all the information of the property from, address and just all those things. It makes it, I don't believe everything on an OM, and most things on the OMs aren't real accurate and true, but it's nice for us to have them just for the reasons of, address and just all the basic information of the properties generally on there. So summary of what you plan to do with the property. If you've run your own pro forma and things, send that over. When we deal with a lot of newer investors that are looking to raise funds. They don't, a lot of people that are just getting started don't have you don't have the net worth and the experience and things to be able to qualify for a lot of these loan programs. So, and I understand that. So when you call me, and you don't have an SREO yet, or a schedule of real estate owned, or your personal financial statement doesn't show the high net worth yet, I'm fine with that. But just know that before you go to get funding, and when we close the deal, there's no getting around having a sponsor that does qualify. You can have the best deal in the world, but you're not going to get qualified if you don't meet the requirements personally. So, and that's where the sponsors or the key KPs and all those things come in. So, but these things here needed for a quote. The top 2 are definite, and a summary of what you plan to do, like what you plan to offer, just all those types of things. So, and I see your hand up, Shelly.
Yeah. If you're done and you're ready to go for the Q&A, I just have a couple of questions.
Okay. All right. So the needed for quote, is right there. I'll just leave that one up. Go ahead with the questions.
It's just questions that somebody had. I think you might have answered this one already. What is the
Chat.
LTV for the February special?
I'm sorry.
What is the LTV for the February special? James had asked that.
Oh, okay. Gotcha. Yeah. When you're looking at the Freddie loans, you're looking at the small balance program, we can go all the way up to 80%. But if we get to 80% and we don't get a 1.2 debt service coverage ratio, we're not able to lend 80%. So if we have to go to 65% to get to the 1.2, that's what, you're not going to be able to get that 80%. So everything is determined by the debt service coverage ratio. So, excuse me. So that's, this number, the debt service coverage ratio, is very important for that reason. So it can, I've quoted deals here in the last 6 months where, I had somebody that was under contract on a deal and we could only loan 40% loan to value, because, the deal just didn't have enough income for the purchase price. And the buyer was okay with that. He was still trying to raise money. He never was able to raise enough money for it. But 60% equity raise on that deal was pretty extreme. But as these interest rates started jumping up right away at the very beginning, I mean, people were trying to buy deals like this. So I'm sure he's happy now that deal didn't go through. But yeah, everything is determined by the debt service coverage ratio. So.
Yeah. I've got another question, and I'm only asking these questions so everybody can hear it, because these are great questions that I'm sure everybody can benefit from. Andrea said, do we need to have an existing portfolio in order to qualify for these loans?
When we're talking, generally speaking, on the loan programs, when you get over $1 million for a loan, in general, whether you're at a local bank, the agencies, CMBS, all the programs, you're generally, if you're borrowing $1 million, you need to have a net worth equal to or greater than the loan amount. So if you are trying to buy a property and the loan is going to be $2 million and your net worth is $1 million, then you're going to have to bring on a partner to make up for that. 2 people together, 3 people, 4 people together can come up with the net worth between them. That counts as well, but you all have to qualify and sign on the debt. So, when you get into like your local banks and things, each one of them has their own criteria as far as like, oh, well, no, we want one person, or what, they're all different. Some of them might be a little easier to work with. Some of them might be harder. But when it comes to the agencies, one or multiple people together can qualify. So.
Okay. I'm going to do one more question here. And if anybody wants to ask a question, please raise your hand or throw it in the chat and I will read it. Alicia, I think that's her name, Alicia. She said, I was wondering how the Fed rate raised in February might affect the rate range of how it might take, how long it might take to affect them.
Oh, before it affects these.
Right.
Yeah, with these, I think these rates until probably next month, they'll probably stay around this range. This is a government program. They're not real fast moving. So I think we're probably going to be in this rate range this month. And next month we might have a little bit of a change, but these here, out of all the programs, if you have a multifamily property that does not qualify for agency debt right now, chances are you're going to be somewhere between 7 and 9%. maybe more depending on the deal. You know, I've seen, you know, some of my lenders have quoted deals at 16% for construction loans and stuff recently. So things are just kind of all over. You know, when the rates were low, you could say, oh, well, you know, 10% was a high rate, or 8% for, you know, this, or, you know, but now, I mean, you could have two different lenders lending on the same thing. You know, both of them, you know, kind of the same program, but one of them is going to be 16%, the other's going to be 12. And, you know, that's kind of where we come in as brokers. You know, we will, you know, shop them around. If you've got bridge debts you're needing to acquire or whatever, we'll shop it around and try to get the best rates for you. So.
Okay.
I see Aldo has his hand up here. Go ahead, Aldo.
Yeah, hopefully you don't get tired of me.
Oh, you're good, bud.
Yeah, I have a couple questions. Number one, I guess, you know, you were talking about this earlier, alluding to it. What are you seeing out there in terms of, you know, owners getting squeezed on some of their variable rates? I'm assuming they go to people like you to see if they can't refi and save their asset, and, you know, not go all the way as high, and maybe they didn't purchase a rate cap or something like that. What are you seeing out there?
Yeah, you know, we're just seeing the beginning of it. You know, a lot of these guys that are going into those situations, a lot of them are going back to the lender that lent on the deal. So the service company,
Mhm.
you know, the service company that's actually servicing the debt, they're going back and trying to renegotiate stuff. You know, it's, you know, like I said, it's kind of a mixed bag with everything. I do know we're in a room with you know, 300 or 400 people a week on Grant Cardone's real estate club calls.
Mhm.
And so we're on a call there every Wednesday at noon. And and there's a few really, I mean, we're in a room full of you know, deck of millionaires and a few billionaires and all that. It's a pretty cool group to be in and hear them all talking every week. But there's a few guys in the club that have a lot of properties, and you know, a few of them were talking last week on the call that they have properties that have you know, gone negative cash flow now because they've had the debts adjusted on it. And those guys are right now just kind of waiting out the storm and hoping that things turn around a little bit before their other properties start getting into those situations. The one guy said he's got 3 of them, but he's got 10 properties, and those 3 are kind of upside down, and he's, you know, having to pull money out of his own pocket to cover the difference. I mean, when you're buying these, I mean, each one of these, depending on how you're structured, I mean, some of them might have a fund where, you know, the fund is lending the equity and people are just investing in the fund. And so that overall fund, you know, they can take all the properties and combine them and pay things, you know, and keep it down if they have some that are cash flow and some that aren't. But then others, they might structure it a different way where each property is its own fund. And you know, so those guys that are investors on that fund are not getting paid right now. You know, and so be careful, you know, when you're going and investing in deals, because when these deals, some of these deals go back to the bank is getting their money out of the deal. I mean, they might have loaned 65 or 70% on the deal, so they're going to be in good shape if these properties drop 30% in value. You know, that bank is still going to be okay because they didn't lend more than 70% on it, generally speaking. But the people that have equity in the deal, I mean, their money vanishes. You know, it's just there one day, gone the next. You know, and so be careful. I know there's people out here in the call here that are LPs on deals. There's some that are, you know, becoming LPs on deals currently, and then there's other ones that are looking for LPs. So, you know, it's you know, in all, I mean, that's the ones that are gonna get most hurt is the equity on the deals if the operator isn't able to weather the storm. So, but but yeah, there's several people in the club that are starting to feel the pain. We haven't gotten a lot of calls just yet, as far as like, hey, we need to refinance. I'm expecting we'll start getting some here on some of these smaller balance because our rates are so good right now. In comparison, I mean, they might have jumped up to 5 to 6%, but I'm if they have a Freddie or Fannie loan right now and their rates jumped up, I mean, Freddie and Fannie are probably some of the safer ones to have debt with, because it's their job to provide affordable housing. They're not going to be as hard line as some of these private lenders are going to have to be, because the private lenders are it's a different animal when they don't have the Congress there to back them up,
Yeah.
So.
And it doesn't sound like, this agency debt, or at least the conventional stuff, has any sort of rate hikes anyway, since they're amortized at, 30 years or whatever, they're just stable, right?
Well, the agency debt and things, you'll have different periods. I mean, you'll have some that,
Sure.
will go 5 years, 10 years. Just on these quotes, it's all 30-year amortized. And you see the terms, 5 years, 7 years, 10 years. So that's your term, and then it adjusts after that,
So you better divest at that point, or, refi.
Yeah. Yep.
And
if you can refi down enough to make a difference,
Sure. Yeah, that makes sense. Somewhat in an unrelated note, how friendly are these agency companies to, I've heard some about this, to maybe incorporating a little bit of a construction loan into the debt stack, again, depending on the condition of the asset.
A lot of the Freddie and Fannie, I mean, they want assets that are livable already. Like I said, 90% or better occupied, generally speaking. Usually that is done through your capital raise. But like I said, it's fluid. If you come in and you have the plan, you have a contractor, all those things will have to be in place, and then all has to be accounted for, when you're signing on. But they will do, light construction, freshen up type stuff. But generally speaking, you're better
What's
off.
that look like? 5,000 a unit or something? What's light look like? Lipstick on the pig kind of deal?
Yeah. I mean, pretty much. I mean, they're not going to be interested in any walls coming out. They're not going to be interested. I mean, you're looking at, some paint, maybe some doors, if you gotta put a roof or whatever it is, so.
Yeah, we've been looking at some like that, and roofs are rough, obviously all Class C stuff. So they would come in and potentially help us with roofing if it affected the functionality of the building.
Potentially, but like I said, I mean, when you start doing that, I mean, it's work buying these, and you're adding a lot more work when you're starting to get into that.
Right.
I mean, if it's me, and you have a $200,000 roofing project that needs to happen, I mean, that, you can judge for yourself. I mean, we can put it through and see what the lenders say. But, just if it was me, I'm like, I'll raise this through my equity, but, it's case by case situations.
Yeah, it's depending on the size and the loan deal. $200,000 is not a lot to raise.
Yeah.
Awesome. Sorry, I'm taking over. Appreciate your time.
Oh, you're good. So,
there's some more questions if you want to answer.
Yeah, we can.
Does anybody want to raise their hand?
Real quick before we take any more questions.
Yeah.
We're going to be at GrowthCon this next week. We won't be. I mean, we do usually every other week. We're going to start doing at some point. We'll start every week, but our next Zoom topic, we're kind of up in the air on what we're going to do. So if anybody has any suggestions, put them in the chat on the Freedom Chasers chat on Facebook. We'd like to hear any suggestions. We'll be talking, of course, current debt market, and then, we'll pick another topic that goes along with it, but we're just not sure what that is just yet. So if anybody has anything they want to hear, reach out and let us know. But we're going to GrowthCon next week in Las Vegas for it's Grant Cardone's GrowthCon. So there are going to be a bunch of people there, and he hasn't released any of the speakers' names or anything. So looking forward to seeing who the speakers are. 2 years ago they had Donald Trump, and last year they had Shaq, and so had a lot of cool different perspectives coming in. So looking forward to hearing who might be there this year. So, but me and Shelly was going, and it was going to be, we're going on Valentine's Day is the first day. So it was like I was like, hey, look what I'm doing for you on Valentine's Day. We're going to a 3-day event. So, but she gave her ticket up to JJ because she said he would enjoy it more than she does. So me and him are going now.
My VIP ticket.
Yeah.
There's
So, but yeah, go ahead with some more questions. And if anybody is, wants to ask, raise their hand and ask, go right ahead. We'll take questions about 5 minutes, and we'll call tonight.
Edward has a question.
Okay.
Let's see if I can read this without coughing or messing up. Can the same sponsor who signed on the debt for you to qualify for both the real estate owned, aka known as experience, as well as the personal statement, also known as network, equal to or greater than the loan? And what does a sponsor usually get out of signing on? What is in it for them typically?
Equity in the deal, generally. They're going to, it's always different. If you're going to somebody that's close to you, and generally the way these deals are structured, you're gonna, the GP team and you have the LP team. The LP team is all the money, and then the GPs, one of them usually has to qualify for the debt. So it's usually, these people put all the money in, these people are doing all the work, and you'll split it, 20%, 80%, 30%, 70%, 25, 75, whatever it is that you decide to come up with for it. This 20% right here is going to be divided between the partners that are buying the deal. So however you decide to divide that up between you and the other partners there is up to you. For me, if I'm coming in and I've got somebody coming to sign on debt and they've got experience and I'm doing the work there, whatever it is, and it's just two of you, why not come in 50-50? I don't see a problem with that myself. You might go in and take 75% of that GP team, or, and they take 25, whatever it is you can agree on with them, So, but generally, if it's somebody that is already experienced, they've done this stuff before, they're going to come in and already know what they want. They're going to have a plan in their mind, what they want. And I would just ask them, say, hey, what do you look to get out of this? So, but generally it's a part ownership or equity or whatever there with the deal. So
Okay.
Do you have more you're reading, or do you want to ask a question, JJ? Go ahead.
I wanted to say I was in the middle of editing a video, but here is a channel that we started for my mom and dad. It's talking about the debt market, a YouTube channel. If you guys want to go and keep stay updated on it, the link is right there in the chat. Go subscribe, and we post a few videos a week. So yeah.
All right. Thanks, JJ.
We're paying him with hugs and kisses.
Yeah. He's been working
on. You guys are
on
breaking up like bad. I can't.
You're the only one that's hearing that.
I'm hearing you break up, JJ. But all right. So go ahead and read the other questions there, Ben.
Somebody asked. Hang on. Something about DSCR. Where to go? Is DSCR ever based on pro forma rates? That's a good question. So
You know,
by the way.
If you are getting bridge debt, they will look at what the future will hold on the property. When you're getting bridge debt, it's short term, usually 1 to 3 years, you know, and you know, you're going to pay a higher percentage and all that because that's a more risky loan. But they're going to look at what, you know, generally you'll get bridge debt if you can't qualify for conventional debt. So you'll get the bridge debt if the property's underperforming, and they're going to look at it and they're going to base the loan on money that you have in the bank to be able to cover their payments and cover all the expenses until you get the property up. And they're going to look at your experience to make sure you're able to do that. And then they're going to base it on what they think is going to happen over the next year when you go to refinance the property into a long-term loan. So yeah, there is that time when they will look at future pro forma DSCR. And right now I will tell you that because of the instability market, the bridge lenders are getting very, very, very tight. And they're really, I mean, they can't look at the market right now and say it's going to be this in a year from now, because nobody knows what it's going to be in a year from now. So when you're looking at pro forma, I mean, that pro forma is going to be based on a lot of what the interest rates do. And, you know, your pro forma on your rents, you know, could be way better. But if we have a couple more rate hikes, you know, the value of the property is going to be lower because you can't borrow as much money on it. So, you know, when the interest rates go up, the cap rates go up and the values go down. So it gets real hairy when you're looking at the bridge loans currently and pro forma, DSCR, that kind of thing. So be careful in those ways. And really the lenders won't let you, they won't let you get into a situation that's bad for you generally. You know, I've heard of some of these bridge lenders that, you know, look at properties and they're like, they think, oh, well, I like that property. And they think, if this guy manages it poorly, we can take it from them, you know, and that some of them will get properties like that. But, you know, if you're going to a bridge lender that is a good lender, been around a while, that kind of thing, you know, they're going to keep you out of trouble. So, and I see William's hand just went up. So go ahead, William.
Hey, Jerry. Hey, how you guys doing?
Good.
I'm driving, so hopefully you can hear me all right. But hey, quick question on GP requirements. You know, I understand, you know, the net worth constraint. Is it typical as well for it as a GP requirement that you have X amount of liquid assets in a bank account typically to qualify for a loan?
Yep. Generally, you know, and a lot of times that'll be raised with your equity raise. You'll raise an extra 10, 15%, you know, or, you know, I'm sorry, 5, 10% for, you know, your money for that reason. You know, you just raise extra money for that. And that'll take care of that a lot of the time because, you know, you're doing the equity raise anyway, raise a little extra money for that, raise a little extra money for your closing cost. And that all usually comes in and play in that form. So I can't hear you if you're talking. So go ahead, Philip.
What's an idea of approximate closing costs? How much should you add to estimate what that would be?
With the agency debt, you're generally going to be around 3.5% or so. That'll be like, you know, you're going to be like 1.5% on, you know, the lenders you know, probably another percent for your, you know, legal fees, those types of things. And then you're going to be having to pay for inspections and stuff like that. That'll be probably another one. So just general, I mean, if you want to be conservative, add 4% just to figure on that. So. Yep.
So Jerry,
I just heard somebody talking, but Pete.
yeah, I just want to clarify, you're including the lender / broker fees in that 3.5%, not just closing costs.
Yeah, that's closing on the agency debt. You're going to be like 1% on the broker fee, which is our fee, and then you're going to be like another 2.5% in closing cost.
Right.
So, yep. So, yeah, how's it going, Peter?
Going fine. Sorry I was late. Had another meeting.
Hey, that happens, man.
So I got two more questions and we can head out.
2 more questions on the chat. Okay. Go ahead.
So Sean says, if the asset is in an opportunity zone, can you still qualify for Freddie small balance program?
Yeah, I mean, if the property is you know, stabilized and you have income to show, you have you know, when you're looking at agency debt, we need good records from the current party that is that's running the property. So we're going to need to see income, we're going to need to see expenses, we're going to need to see all those things. So, you know, the opportunity zone doesn't, I mean, that doesn't keep us from being able to lend on those properties. So now there are special cases where, you know, an extremely high crime rate or something like that, where the lender might back out because of something like that. But, you know, but being an opportunity zone doesn't pull it out. So, and actually an opportunity zone, you know, if you have affordable housing and things like that, you'll probably get even more favorable terms from the agencies, because, you know, they're mission driven to provide affordable housing. So
yeah. One more question. Have you seen deals starting to trade at higher cap rates yet?
Oh yeah. I mean, deals are I mean, there's really not much trading right now. I see prices coming down and getting higher cap rates when you're looking at deals that are for sale. But really, I mean, Peter will tell you too. He's a lender and lends in the commercial space, and he'll tell you that, you know, there's just not much. There's not a lot of trading going on. So it's we're in a lull here for right now, and you know, things will open up here sometime this year, I think. But there's just not a lot of actual trading going on. But when the trading does happen, the cap rates will be higher because you know, the affordability. Now, if interest rates tomorrow go back down to 3%, the cap rates will go back down with it, and the property values will go shooting right back up. But as it sits right now, people, I mean, every buyer that's buying these deals has to come up, you know, has to look at the numbers the same way you do. So there's nobody coming in with some secret formula on these deals. You know, when you're looking at these deals, when the lenders are looking at these deals, they're all looking at the same numbers. They're all going to come up with the same debt service coverage ratio. They're all gonna look at these things through the same binoculars. So, and there's not a lot of trading going on. There is some, but, you know, mortgage rates from December of 2021 to 2022 sorry, mortgage originations and refinances are down, I think it was 87% from December to December. So that tells the whole story on what the market's doing. So
yeah. One more question.
So, all right, go ahead.
I don't know how to pronounce Rayan. I notice most sellers still calculating at a 5.5% cap rate instead of their city cap rate. Is this normal, or is this expected to start trading up back to their specific city cap rate?
Well, when you talk about the city cap rate, I mean, price is made up. So if you make an offer on a property at $2 million, the seller's off wanting 2.5, the guy across the street can ask $5 million for the same property. The price is made up. If you can get a seller to come to a price that you like, you can make money on it. I mean, that's right now. I mean, when interest rates were stable, and everything was the same, and things were, 7 or 8 months ago or 9 months ago, you could say, hey, in Miami and in this neighborhood, you're going to pay this cap, or in Philadelphia, in that neighborhood, you're going to get that cap rate. Well, there's not enough stuff trading right now to be able to say that about anywhere. So when you say price is made up, on any product, price is made up. It's what can you get that guy down the street to pay you for what you have. And so the seller saying, hey, I want this much money, and you saying, I want to pay that much money. It's whatever you guys can come up with that makes sense for both. And that's, cap rates aside, whatever aside, if it makes sense, it makes sense. If it doesn't make sense, it doesn't make sense. I mean, so I hope that helps. But as far as like actual cap rates for actual cities, I don't think that I don't think that exists right now. If you talk to a broker, a sales broker that's a real estate broker, they're going to tell you, oh, well, it's this or it's that, because they have properties for sale in that range. But I mean, they know that 5 cap now is probably trading at a 7. If you're buying a property in Ohio right now, you're probably going to pay an 8% cap or a 9% cap, sometimes even higher. I mean, it's just, things are changing right now. When things aren't trading, especially, it's hard to say, what the cap rate is. So.
All right. Why don't you go down to the next slide?
All righty.
And we'll head out. Thank you, everybody, for joining us. I know we ran over time. We always run over time for some reason. But we got to get all these great questions answered, right?
I know a lot of you all on here are already freedom chasers. But if you are not familiar with the community, are you able to put the Facebook group in the chat?
It's right there.
Join the Facebook group. This right here, there's a lot of paid programs out there. I mean, people pay a lot of money to get the information that you'll get in this group. Peter St. Martin, it's here. It just was talking a few minutes ago. He does the broker calls on Tuesday, and those at 2:00 p.m. Yeah, during the day, because these brokers don't answer the phone after 5 or 6 o'clock. So, but
it's live, and I've been on there. It's pretty good. You guys do a good job.
Yeah. So
they don't answer the phone during the day, Jerry.
Yeah.
The one I jumped on last week, I think, yes, one of the guys answered the call, and it was live, and it was really good to hear, to experience.
We usually get 1 or 2, but it's hard. I mean, I've spent the whole hour and a half dialing, and we reach nobody. You just never know.
Yeah.
Oh yeah. When we're in the Grant Cardone's real estate club, and he'll stand on stage at the summit, and he'll have you know, sometimes 1,200 people in the room, and he'll be calling these brokers from the stage just to talk to people. And nobody answers the phone. You know, it's like he'll call 3 or 4 people and nobody answers. And then for the next hour, he's getting calls back from all these people because they'll hear his message. He'll leave a message. Grant Cardone's calling, you got to call him back, you know, but yeah, you know, we talked about all the different calls. You know, I encourage everybody to join the Facebook group and to jump on these other calls and things as well. If you haven't already, a lot of good information. I mean, people pay these mentorship groups, you know, 25 to 50,000 bucks a pop for this same information you can get in here for free. So don't take advantage of it and not do it. Do it while it's, I mean, who knows how long everybody's going to be doing these things, and get the free information while it's free. So I don't think anybody has intentions of charging, but you know, on Sundays we're getting over 100 people in there now. So I mean, at some point, not everybody's going to be able to fit. So
yeah, if you guys enjoyed this and thought this was educational and helpful, let us know in the chat, please.
So I'm going to quit sharing my screen.
Awesome. Thank you, guys.
And so you can take over again on your end.
Yeah, did everybody get, so I'm gonna go ahead and play you guys some cash flow music. It's Grant Cardone's song.
Everybody being on here. Feel free to reach out if you have any questions about anything. You should have our numbers and stuff. We put it on the screen. So have a good rest of the week.
Have a good night.
When I walk through the door, I'm talking cash flow.
In games if you like.
And if you know, like I know, you getting cash flow. Rule 1, getting money, never losing no. But I'm broke, but now I'm living at it. They just count my zeros and some decimals. And I wish you would try to test me, yo. You should listen to the lesson, no. Masterminds out of Mexico, I invested though when I let it grow. Regiments I got a pocket for. Raise your income and your taxes low. Spend it right and then invest some more. And if you don't believe me, ask my doctor down. What you mean? You mean Uncle G? Planting seeds for these money trees. Who got my money, please? Everywhere you wanna be like Visa, MasterCard, American Express. I bought the bank and I bought the jet. I buy apartments, I send checks. Yo, billionaire went undercover, help y'all discover who did it best. Just bought 2 choppers, can't wait till they see the face and they see what I do next. When I walk through the door, I'm talking cash flow. And if you know, like I know, you getting cash flow. When I walk through the door, I'm talking cash flow. And if you know, like I know, you getting cash flow.
Yeah, and only then do I buy something stupid. How stupid can you go? You can go as stupid as your cash flow.
You know what heals all ills? Deals. Look who went from meals to bills. It's eat what you kill when you're in the field. In the pipeline overflowing, I don't drip or spill. We don't seek balance, nah, we want extraordinary. If you really knew my dreams, it'd be more than scary. We got more to spare, ain't no shortage, baby. Winning by the chopper and another for my lady. Talking about the bird and the strap, say the word and she handle that. Fully loaded, put it at the target and you know we letting off every man. Got money, who got my back? You can never get it if you never ask. Big bags, legendary swag. Only one thing better than